So then they're stuck in the same mentality of, I'm never getting the pullbacks to my zone. My zones are never holding. Every time I get an entry, I close too early. What's going on? Well, the main issue that's probably presenting itself. Quick disclaimer, these videos are meant for educational purposes only. Anything said or shown in any of these videos are personal opinion and my perspective. Trading carries a high level of risk, so anything done is your responsibility. So without further ado, let's jump right into it. Now, yesterday at Sunday open, so just so you guys know, these videos come out a little bit later, but this is recorded on 5/2, and the trade I'm going to be talking about was right here on 5/1, so the 1st of May. So first of all, happy May to everyone. I know this is going to probably be uploaded way into May or even after May, but nonetheless, I hope you're all having an amazing month, no matter what month it is right now. I hope you're all doing well, and I hope you're all slowly progressing and learning. Well, hopefully, if you're watching mentfx, you're progressing much quicker. My ear looks a little weird because it's the only one that's out, so there we go. What I wanted to talk about today was something actually really important that one of our members in the mentorship actually said during one of our trading sessions. So very quickly, it's not going to be a crazy breakdown. However, as you guys know, I've been very bullish. Sorry, Jesus. I just made the last 15 videos about being bullish on UJ, but as you all know, we've been very bullish on UJ, and that bullishness is, I'm basically looking to sustain it. I was looking at some inside SND in there, and one down here, which is basically taking into effect this daily, and my bias for the week still, and as it has been with the mentorship and the same way that I've done it in the outlook, is still looking for that topside delivery to keep clearing highs. There's no reason that we need to predict otherwise, right? Remember what I like to say, it's better to be wrong once at the very end of a trend if it wants to liquidate, rather than 500 times as everyone's trying to sell this market over and over and over again, right? And using this philosophy, we've been on the correct side very much so ever since. If you all remember, I talk about this all the time now, ever since this area here. Why do I keep talking about this area? Because this is only going to happen once every, half a decade, right? Remember, this buildup of this range and the reasoning for these longs in here came from the buildup of this range here from a very, very long time ago, from this original breakout structure here. And after that range built up for the last, as I said, about 2,000 days, aka about 5.5 years, when we saw the inside accumulations that occurred prior, as well as the accumulations that were occurring here, and began to watch it during this time, following every 3-box method that formed off of it: structure, S&D, confirm, structure, S&D, confirm, structure, S&D, confirm, etc. As we started seeing all those and started to do our analysis on them, we predicted this beautiful buy out of it, and that buy has been and continuing to sustain itself, while at the same time you have, as I like to bring it up, and we're going to do this very quickly, but as you have, the population or the general retail crowd, about 76% short on this, or even more in some cases. I'm sure there's a lot of mentorships that were short on this. It doesn't really make sense, even though they might be saying, yeah, we're overall long, we need to see a pullback, we need to see a pullback, we need to see a pullback. And when you're stuck in that pullback mentality, you're looking for anything to catch a price rather than allowing it to keep going and keep going and keep going. And something beautiful I heard said in one of my webinars with our community, right? And this is why you guys should join up, because some beautiful gems get spilled every single week, every single day. But something funny that was once said was, there's this billionaire trader idea, this trader that used to make a shit ton of money. His saying or his quote was, if the chart hits the top right of my screen, I buy. If the chart is in the bottom right of my screen, I sell. And the reasoning for that was really because, people are really attuned to this idea of thinking mean reversion, always. They want to see price always return to an area, or bounce back to an area, or pull back to any retracement, rather than trying to stick and look for an entry or positioning that takes them with the trend and with the areas and continues to run a liquidity on the top side or whatever it might be. Right? So for instance, if you're a trader and, forget that this is a daily chart for just a second. If you're a trader and you're watching this chart and it comes up here, a lot of people are looking at this as a potential, okay, we're breaking out of our thing. We have so much, white space here. We need to go down, and everyone wants to short this, right? But because it's in the top right quadrant of your screen, that's a good buying signal. And, lo and behold, still in the top right of your screen, still a buying signal. Top right of your screen, still a buying signal. Top right of your screen, still a buying signal, right? And for a lot of people, whether they're looking at this in MetaTrader or on their trading platforms or on their institutional platforms, it doesn't matter what they're looking at. The price is in front of your screen, and the price is at the top of your screen. So a lot of people just anticipate and believe that because it's in a certain area, it's guaranteed to go down. And instead of looking, for a way to get positioned into this continuation long, they're looking left wherever they can, right? In this case, there's not much left, but they're looking left as far as they can to find the next area of support or resistance, or the next area that could hold price, the next supply that, again, isn't supported by structure to hold price. Remember, supply and demand, the way we teach it here, has to be founded within an institutional bias, founded within a structural bias, founded within the most recent ranges put forward by whoever the operators of that market are, right? And as you're following the most recent ranges put forward, right, boom, following the most recent ranges put forward, what you're doing is you're following in the actual footsteps of smart money getting involved on accumulations, on distributions, on the new range, getting involved, and then running to the next point of liquidity, and so on and so on and so on, right? Instead of looking as far left as you can to say, maybe we want to catch this support, maybe we want to catch this support, maybe we want to catch this support, maybe we want to catch this support. And what's happening is on your screen, even as you're zoomed in, this is at the bottom of your screen now, you want to see longs, it breaks right through your longs. At the very bottom of your screen here, you want to see longs, it breaks through them. You want to see longs here at the very bottom of your screen, it breaks right through them, right? You look left here, right? A lot of traders, even right now, are going, yep, we have a very potent area of supply or resistance here. But again, this resistance isn't characterized by any zone, by any up move before a down move. There is no orders that have been actually presented into it. It might be a value area, but the reality of it is it just might act as a very minor bounce before a continuation, right? And I mean, we can kind of take a look at that. I don't know exactly what happened here, but yeah, there you have it, right? That's where you find your tiny little bounce before a continuation. And this bounce, even though it may seem small on a lower time frame, is a lot of retail or dumb money falling into the continuous trap of, oh my god, we found our peaking point, we're hitting the major resistance of the year, it has to hold here, right? And then the understanding just falls apart. This is why I teach you guys to always create an understanding or a bias within a prior structural narrative. That's why I teach you guys to follow the 3-box method. You find your first box always. That's the first box. Then you can find and pinpoint your zone of the box based on whether it's a bullish impulse or a bearish impulse, and then you want to find that confirmation rather than looking for this area first. Because when you dissect and start looking at this area here, right here first, you start looking at every possible area you can possibly find on your charts, and now once again, as you all know and love, we are in the striped pajama fallacy. And if you're new, the striped pajama fallacy is just like a striped pajama. You have a lot of zones, but they hold no bearing. There's nothing you can do between them. Zones get tested, traded through, retested, traded through, traded back, faked out, whatever you want to call it. There is no bearing as to like an anticipation in price. Whereas, instead of acting from that end, we look at a price and say, where has the most recent range been formed from? Where is price moving based on a higher to a lower time frame? And based on that, what can we anticipate within the movement of price? And just like we did an analysis on the daily here and said that we should anticipate a bullish movement in price due to the fact that bullish S&D zones are being sustained within bullish ranges and continuing to sustain them within an even higher time frame bullish range that could be heading for the next liquidity high on a higher time frame, and then holding those moves, we can anticipate that bullish moves are going to deliver either A, from major pullbacks into our demand zones and continuations, major pullbacks into our demand zones and then continuations, major pullbacks into our demand zones and then continuations, or major continuations with some minor pullbacks that on lower time frames are going to act as bullish structural impulses once they shift, because we understand this idea of fractals, and we understand that even in Dow theory, right, there is an element of Elliot, which is going to always take into account the fact that liquidations could be an easy part of a guaranteed structure. And again, how do you tell where you are? Because you look at multi-time frame confluence. So that in mind, I have been very bullish on this. You guys all know that. However, at the start of this week, as I spoke about with our team, because of the fact, and if you guys remember, I spoke about it, we had a lot of members in longs from here, from down here. Some of them are still holding the longs as swing traders because some people get involved swing-wise, but because, in the mentor space, a lot of mentors are always going to be day traders because, they're actively watching charts and actively seeing things and can actively teach it, whereas swing traders are more long-term kind of based, which is fine. That's just why I found that in the mentor space, you get a lot more day trading, right? However, That said, all those people that were holding longs are still probably holding longs from all the way back here. However, we also had a few members get into longs from inside of here, from inside of here, and from inside of here, and have been holding that over the last week. And what we spoke about was, if you guys remember in the last few videos, we spoke about the theory of Dow continuation, which is the idea that in, a bearish market of some sort, when you see a trade above a previous protected high, which is what we call it here in mentfx, and then a structural impulse that actually puts in a higher low, as you want to call it, or tests the previous S&D and then breaks again with displacement. So again, if you don't know what any of these words are, make sure you've seen my other videos. Then we can anticipate that because we've had the double break of basically the Dow theory of continuation, we could expect some form of bearishness for a little bit, or the market is just presenting at this moment some kind of bearish narrative. And that's exactly what we spoke about when, people were asking, hey, mentfx, how can I look to potentially manage my longs if I'm in this, right? Because no one knows how high UJ can fly, right? And again, overall, I'm still bullish on it and I want it to be bullish. However, if you are a day trader or someone that's more short based or looks to get positioned and then looks to potentially exit and leave portions to run on, you want to know the best and most efficient way to basically create the best management. And now the best management isn't to always close at a given RR. Instead, it's to follow the move until the order flow is fractured. That's where this idea of order flow changing comes in, right? That's where this idea of BOS or change of character or any of this other stuff comes in. But in reality, all you really have to follow, right, is BOS to the downside, second BOS to the downside, that is displacement, right? That is showing you everything that, you might be taught elsewhere in different ways. However, that's what most mentors are trying to get across to you. So the idea is, when we had members in this long and looking at a 15-minute, we can see real structural ranges being put in, right? And we can draw them out now, right? So people are in longs, right? We're drawing out our structural narrative, right? Breaking higher, breaking higher, breaking higher, breaking higher. So and then you can see this high here came from this low due to the fact that we had a major displacement and liquidation on the lower side here, and then the break above. Now again, I have more stuff on this in the mentorship, so I'm not going to break it down here as it'll make the video too long. But overall, the easiest way to think about it is break structure to the top side comes from this low, right? Same thing, 3-box setup. Box 1, box 2, potential box 3 in here, but we're not looking to long it right now because you're already either in longs or maybe you're looking to position here. That could be the case. But overall, what we do know is that this is a low, a major low, right? Which is holding up, in this case, this structural impulse right here. Then as you see price break down, that's basically what we consider that break 1, which now can function in one of two ways. Either it's going to function as a higher time frame Elliot wave based setup where basically, it's creating that as a fractal to take out lows, but it's still holding a bullish position. Or B, it starts to move lower, in which case, this could still happen, but it becomes less probable when we get the second break. And the second break occurred, we had some of our traders exit this, right? So one of those being, I think if I go to my Discord right now, yeah, so Joya Trader got in the same trade as me yesterday during Sunday. So he entered here for a sell and started holding that down. Chris also got into a trade right here. Right, he got into it originally, very beautiful, went to break even. Here he is riding that down, right? And then we had Joya Trader keep riding it down, was looking for that liquidation there. And then we, as we keep following it, I was out pretty early, so I can break that down too. I'm actually gonna break that down in the mentorship. I'm gonna skip breaking it down here because there's no point. But the same philosophy is applied in terms of following ranges on a lower time frame and allowing them to potentially run, but if they don't, understanding where you can exit. Because again, every trade that I start with, especially from these lower time frames, because I'm entering on anywhere from the 1 second to the 1 minute, start as scalps, and I look to manage them as scalps. And if those management criteria don't get met, aka price keeps running but doesn't give me an exit, then that means I can now work my timeframes up and allow that scalp to potentially play out into a normal intra-week trade or a swing trade, or in very, very rare cases for me at least, a positional trade, right? Sometimes I will get a trade that does just run and run and run. I think one of my best ones of all time was about, I believe it was between 250 to 300 RR. Now again, when I say that, please don't go into the comments, Mr. Scammer. 250 to 300 RR entails, and I think I'm gonna talk about this in a future video, but entails about 1, 2, 3, 4, 5, 6. So I think about 6 or 7 overall partials, right? And remember, those 6 or 7 overall partials on each RR leg that I look for, or each structural impulse and next structural liquidity point I'm looking for, is also originally a 0.2% trade, right? So even for instance, 30 RR gain on an account, just an example, right? Even in my last videos, I spoke about this. A 30 RR gain on an account, which, you know, some people, you know, come to me at the first time and go, 30 RR, you made 30%, bullshit, you'd be like multi-billionaire, whatever the fuck, right? At 0.2% works out to about 6% on the actual account, and then subtracted from that should be any losses that you might have encountered on the way, which again, my win rate is pretty good, so it's not like huge, but again, when you're trading lower time frames, you're paying a good amount of money for commissions, since even when you get broken even on trades, you know, you could be taking a small, you know, a slippage loss or a commission loss. So that's very normal, right? So you have to realize that too. And similarly, you know, when you have something that runs 350, you know, you're taking off, you know, so this actual 350 at its final, right? So that 350 RR at the very, very finale, and I think it was more like, I think this is between 250 and 300. So, you know, let's assume 300 RR. That 300 RR at its final partial ends up being in total, just the final partial, like taking, you know, I take a partial at around the 10 mark, the 25 mark, the 50, and then the 100, then about a 175. And then anywhere from 250 to 300, right? So you're talking on just that last trade, that, you know, that last partial. So let's say like this high right here was 350 RR fully from the trade from down here, right? That final TP on just that 350 only nets me plus 4.67 RR. And that 4.67 RR is actually equivalent in actual, you know, number to 0.93%. Now, of course, you know, you have the other percentages too, because you took off, you know, the original 1 to 10, which secured you 5 RR. Then you took off the 25, which secured you 6.25 RR, right? Then you took off at 50, which secured you 25, 12.5, 6.25, 3.12 RR, right? And then you'd have to add all these up. So you have your, you know, your 5 plus your 6 plus your 3 plus your 4.67 here, etc. Right? You just have to add them all up, and in the end, again, I'm doing the math wrong, but in the end, it works out to being X RR that you actually took out of that major runner, and then that gets multiplied by the actual risk that you have on the account, and that changes the, you know, the narrative from, wow, you went 350 RR, you made 350%, you tripled your account. No, that's not how it works. I just know that my system works for me, so I allow the potential scalps to become large trades. And usually it does not happen, right? And usually what you'll actually see from a standpoint of my trades, I actually took a break even today, is, this is the only other trade I took, and this was on Sunday, is that, you know, this runner, not even runner, sorry, this was only a 4.2 RR trade for me. Again, is it 4.2 RR? No, it's 4.2 times 0.2 as my risk, which is a 0.84% gain minus whatever slippage or commissions that there might have existed with this, right? So that was only that much of a gain. You know, it's still minor gains, you know, on an equity curve. Over time, it'll, you know, look like this. And then, you know, when you have your bigger runners, you get your little move up, maybe more down, right? Up, down moves, etc. Right? Like I've shown you guys what this equity curve might kind of look like. It's more of something like this, right? This is more of like what you can expect out of an equity curve that's based on this kind of system, right? That's based on a higher RR. You know, like this is the kind of thing you want to think about when it comes to building a system out of a lower win rate and a higher RR. That's a very normal way to think about it. However, over time, a lot of systems, regardless of the win rates on them and RRs on them, so whether you're high win rate, lower R, or very lower win rate, higher R, are going to pretty much balance out to looking like this across the board. Now, there's going to be difference, of course, but that's just what I've noticed. Oh shit! What I've noticed between myself and my students, you know, over the last, you know, 2 years of just mentoring and teaching from one-on-ones now to the full-on like community. So yeah. But the main thing I did want to speak about, right, is the fact that, you know, as I'm getting involved on this, and so are our actual students and members as we're watching this, and, you know, people are taking this down and absolutely milking it, is this beautiful rule posted by this guy right here. He said, this is probably the biggest thing that helped me here. Well, one of them, simply knowing when to properly break even. So I actually have a video on properly breaking even, and you should learn about that. You should see it. I think I say use this strategy, and there's a little Bob the Builder on the front. So look that up. Just type in use this strategy mentfx and you'll find it. But the idea is to, you know, if you're in an entry, and let's say you take an entry right here, price begins to run, whatever time frame you use to confirm this entry, you should follow the 3 blocks from it. So like on a lower time frame, if price comes in, breaks down, right, and then comes up and breaks down and it's below your entry, that's already a break even if price comes back up. And here's why, and this is the best way to start thinking about it, right? Let's read this rule that he wrote out. I think it's a phenomenal rule. That's why I want to share it with all of you. He says after every new SND is formed, I think he meant structure here. So after every new structural leg is formed, or protected high, protected low, above or below your entry, right? So this is the idea. If your entry's here and a new structural leg with an SND in this case, and so SND means supply and demand, is formed under your actual entry, go break even. So that's my rule that I use myself, but it looks like he wrote it out, and I'm happy he did it because he followed it up by saying this: if price hits your break even, it simply wasn't truly with the institutions. And I think this is a great way of thinking. And now again, you can think about it as institutions or the composite operator, the composite man, multi hedge funds, multiple institutions, governments, however you want to think about it. But the best way is just big money, right? Or the composite operator, the way I teach it, the composite man, the founding father who introduced that is Richard Wyckoff, right? And that's how he thought. And it's a good way to think because that's really what's occurring. There's large sums of money coming in certain ways. In some cases, you could call algorithmically, across timeframes, fractally, because there's this need for exchange, right? And you can see that in the charts. But what's beautiful is, if you're getting into a trade, so let's say you're getting into this trade, what you guys have all probably recognized is when you're correct about that trade and you're on the correct side, right? Even if you've been a retail trader and you're now on the correct side and you're in that trade, oftentimes there's very little time to play around, right? What oftentimes happens is you start experiencing large, unprecedented moves with, minor pullbacks that might liquidate some inside ranges, large, unprecedented moves, large, right? Huge moves. And similarly, you're going to see this across all time frames, of course, just like we have over the last, X amount of time, X amount of months on here, right? You have these huge unprecedented moves that are coming after that smart money setup has occurred, right? If you're entering off of this long right here, it's literally, in this case days, but if this was a lower time frame chart, it's minutes. But in this case, it's a few candles until you know that you're with the smart money, right? Similarly, if you're entering within this zone on this time frame, it's only a matter of a few days before you know you're with the money. Similarly, if you're entering here for a few days, or a few candles later, very much so that you're probably with the money. And when it explodes, that you're moving with the big fish, right? You're attached to that shark now, and you're just going with it. You're with the current, right? You're that turtle in Nemo that gets in and goes, all right, here I go, right? I'm in the current. That's exactly what you're aiming to do when you're looking for these smart money setups or these 3-box setups and getting involved in them, managing yourself to properly, take that trade and break even if you have to. And if it runs, it runs. And that's when, you sit back and let it do its thing. That's how you build that. So, what's occurring here, right, is as I'm getting involved on whatever time frame, as people are getting involved, we're just looking for a reason to break even, because the thing is, if we're wrong and it comes back up, that's it. We take a step back, we reevaluate where we are, we figure out what ranges we're in, we figure out if the bias is still holding, and if it is, we can look to potentially reposition ourselves. But the truth behind any market, and I'm sure a lot of you have noticed this, is when you're correct, and your best trades and your most profitable trades are oftentimes not when price comes to your entry and hangs around your entry like this, right? This is not usually where probably your best trades are. Or, if this is entry price, if price is doing something like this, there's a good chance that we all know what's going to happen here. I'm not even going to break it down, right? But you're going to see that most of your losses or break evens are trades that look like this. And you're going to also notice, for the most part, now, this is not always the case, but almost always, for the most part, the best trades are more so something like this, right? Your setup happens, and there's really no time to wait around, right? Price is gapping, swallowing up, nonstop going, and you just go, whoa, this is explosion. And the thing is, a lot of retail or dumb-minded or, the psychologically inept, are closing their trades here, right? Because this is more gain on their account than they've ever experienced. And they're not willing to experience this if their actual criteria takes into account potential runners, they don't even allow themselves to experience this. So then they're stuck in the same mentality of, I'm never getting the pullbacks to my zone. My zones are never holding. Every time I get an entry, I close too early. What's going on? Well, the main issue that's probably presenting itself is you're not aware of this fact right here, which is, once you're at BE, the reality is, or at break even, right? That means you're moving your stop loss to a point where if it gets hit, you're really not losing anything on the trade. It's just kind of, it's like as if it never happened, right? Or you're paying cents on commissions. That's how you can think about it, right? The thing people don't realize is that if it comes back, it's just not, your trade is just not with the big fish. That's it. And you just have to wait until that big fish move presents itself. And it's going to present itself across every single time frame. Sometimes, the daily will be stuck in a very longer term, you could say, range within a structural narrative. Great. But the 1 hour could be delivering absolutely beautiful, footprint-like ranges that just blow up within those ranges, and then, they create that chop or whatever you want to call it, right? But the idea is you need to get used to understanding that break-evens and losses are not bad things. They are just proof that you weren't with the big money at that time, and you should just wait and allow for the best trades to present themselves. Just like this, right? It simply wasn't truly with the institutions. You'll know when your move is on the correct side, right? Even this, sometimes I'll even take a trade, and then, it ends up going in my direction. A lot of people are not able to take a trade like this, close it because your rules for closure are met, and then let a trade run. A lot of people will be trying to, get back in this, or they'll wait, they're like, oh, it's probably going bullish again, and then just breaks like this, and you're like, oh my god, it's breaking this big structure, and these structures, I need to go short. I can do this. My FTMO, 1-to-1 at least. There's no way it comes from there's no way it comes for this stop here, right? And then it'll come and run it, because you're again diverging from rules, right? Instead of just following the actual rule, which is I'm getting involved. If it doesn't run and it doesn't give me my exit criteria, then I can stay on it. If it gives me my exit criteria, which it did for me right here, by the way, I was following a 5-second mitigation, so the 5-second gave me an exit criteria inside of here, so I closed it, and then it continued. But my rule is I stop trading after a win, right? That's just my normal rule. So after a win in a day, or a big win, I either stop for the day or stop for the week. That's just how I trade for myself personally, and it works for me well, right? So that's what I prefer to do. But the reality is a lot of people are not willing to do that, or will keep trades open so they can, get even stopped out. Some people that even took this potentially, right? Maybe you even had the same trade as me, allowed it to run, the 1-to-30, but kept holding it, let it come back to hit break even, and then said, oh my god, look, it just hit it and then went short. It has to be short. Wyckoff, it has to be short, right? They're trying to get back in, normal stop, over leveraging, and they're stopped. And market churns bullish, back to bearish, whatever, and they're back in the cycle of, they're back in the cycle of need, and they keep on trying to take from the market, but the market's never going to give it to you, because the market's not here for you. It's not even against you, right? The only person against you is you. So focus on yourself, focus on the inside, focus on what you're doing, and focus on, getting positioned, managing that risk, allowing it to break even, and just looking at that trade going, good. It broke even, you know why? Because I wasn't with the main money. And even if it moves after that, it doesn't matter, because you're starting to train yourself to actually think from the philosophy that I'm trying to teach you here, which is we are smart money-based traders. We have married the idea of Wyckoff, Dow, and Elliot, which are the best 3 ways of thinking, and sprinkled the top with smart money. And what we're doing now is we're saying, okay, those main elements of something like Wyckoff, which is the composite operator, is that once you're involved on a given smart money move or accumulation, right? That move, if you're correct about, will take whatever demand was in that area abnormally higher, right, to the next area of actual available supply, and it'll start that markup cycle. And once you're in that markup cycle, there's a good chance you can just manage yourself at break even. No, none of that trailing stuff, right? Depends on what your rules are, but none of that trailing stuff. Run. Not financial advice, by the way. Of course, you guys should be testing and doing all the necessary, testing on your own ends. But yeah, the idea is, you want to just program yourself to think through the philosophy that you're learning here, right? What I'm teaching you is the why, but I'm also then showing you this completely every single week after week after week with different precision points and different refinements and different nuances between multiple markets and multiple setups. And then I'm basically, you take the 3 blocks and you understand it from a standpoint of smart money can accumulate. And if it does come back from mitigation, it's going to accumulate big time. And if I'm correct, I'm going to be with the institutions. And if I'm with the institutions, it's going to run. And that's what you look for. And then what do you see? You see higher time frames falling in line. You see lower time frames creating those markups. It makes those markups. It runs. It stops. It finds its bearing, but it's still bullish, right? It finds its bearing. It starts breaking around, breaks bullish again within a bullish bias, comes in, hits it, starts running, but it's not with the move, right? It comes back to break even. Why does it come back to break even? Because the smart money isn't making the move yet. You get involved again, starts going long, breaks down. It hits you at break even. Great. We have 2 break evens. Phenomenal. We love it. We get involved again. Does the move ever come back to break even? No. Why? Because now you are truly with the institutions from the real demand zone, from the real 3-box system, aka the new impulse that has formed within the overall delivery of price. And off we go. Deliver, deliver, deliver. And when you're break even on this trade, you're not in worry mode of price, coming back down there, because you understand that you've now positioned yourself with the big fish, right? Or the composite operator. And now you can live that cycle out until there's a real basis not to. And you can keep on upping yourself in time frames and looking for that double Dow Theory rule to get yourself out, because what's that showing you is that there's finally a break in that continuality. And again, there's a lot of depth to what you can do with that multi-time frame approach in terms of actually managing, which I'm not going to go over here. I might go over in the mentorship. And again, if you want to surround yourself with people like me, people like yourself that are on your level, below your level, and in some cases significantly above your level, that have taken themselves to the next level. But that said, you get positioned and you're going, right? So the thing you want to look for is, keep that in the back of your mind. Program yourself to start thinking that way. Program yourself to use the philosophy taught here, that's merged the best disciplines in the entire world together, and, follow it to actually create confidence in your own trading. Know that when you get that break even hit and then it runs in your direction, you take a step back, you say, my program didn't execute here and I'm not with the institutions. When it hits that break even, that's it. You just weren't with the institutions. Look for your re-entries. If you get in and it begins to run and you're at break even, there's no reason to start like closing early or being frantic or afraid, right? Because a lot of people do that too. You just want to let that move with the institutions happen, because once you're truly placed with the institutions, you can let that move happen and it can make you money, right? And that's how you can do that. And again, not financial advice, blah, 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 blah. I hope you guys enjoyed this video. Thank you all so much for watching, and I'll see you all in the next one. See you guys.